Hello, I'm Debbie Bell Hosking in the FinextraTV virtual studio, bringing you part of our Predict 2026 series. And I'm joined by Sergey Nazarov, co-founder of Chainlink, and we're going to be talking about the acceleration in digital assets. Sergey, a big welcome to our virtual studio.
Pleasure to be here. Thank you for having me.
We're talking about this acceleration in digital assets, but first of all, because we're doing Predict 2026, can I ask you, please, what is the most influential change you've seen this year that you think may define the start of 2026?
The stablecoin legislation out of the United States, I think, is by far the most influential thing that happened this year. The Genius Act, which me and my team were involved in helping create with the legislators in DC, basically unlocked the ability for stablecoins to be generated by institutions. I see a huge amount of stablecoins being generated for various purposes, payments purposes, remittance purposes, and that's a very far to go still field with the yield sharing stablecoins. And so that has accelerated, I would say, institutional adoption of stablecoins, which is very important for the digital asset market in general, because stablecoins represent essentially the purchasing power of the market, right? So if there's $200 billion worth of stablecoins on all chains, it's very different than if there's 2 billion and if there's 2 trillion, right? So I think we're going to go from the 300-400 billion world where we are now to the 2 trillion plus world, which means there's going to be a bigger market of capital that can easily and efficiently and frictionlessly go into your financial product or purchase your new issuance. So I would say that stablecoin legislation has really accelerated things. I think the Trump administration has a huge commitment to the crypto and the digital asset industry, both in the Web3 public chain sense and in the institutional digital asset sense. And so I think that if there's legislation like that in the coming year, for market structure, it'll have an even bigger impact because it's more wide-ranging, that legislation. But for sure, the acceleration in stablecoins, thanks to clear regulatory guidance and legislation from the US, is the biggest thing.
And I remember we spoke at Sibos. You spoke to one of the other FinextraTV presenters. Stablecoin was a big topic even then. And of course, when you did speak to FinextraTV at Sibos, you spoke about this blending of traditional and decentralized finance. Now, if that continues, how do you think policymakers will view digital assets?
I think there's a bit of a conundrum for policymakers because the levels of control, direct control they're used to having over financial products and financial institutions is not the level of control I think they're going to have over decentralized finance protocols and at least back-end systems. Maybe the interfaces or the portals, they could still have a certain level of control over the on-ramps, the off-ramps. So from a regulator's point of view, digital assets are pretty clean cut, right? You're tokenizing equity, you're tokenizing a commodity, you're going to have to comply with the regulations related to equities and commodities. Cryptocurrency is a gray area that still is not fully resolved, but in the process of being resolved. But from the point of view of decentralized finance and traditional finance, I actually think it'll be less about cryptocurrency and it'll be more about tokenized equity, tokenized commodity, tokenized fund. So the regulation of the tokenized equity, commodity, and fund will be relatively clear, and it'll be relatively clear what the institution does and does not do in relation to that now tokenized form of an equity or a commodity or a fund. Decentralized finance is essentially a place where people make advanced financial products that are in compliance within the gray areas of regulation where clarity doesn't exist. And so now what we're going to have is a period of both legislation and rulemaking where the decentralized finance community will get guidance on how it needs to comply. And if regulators take a very firm stance or a very onerous stance, then the decentralized finance community will continue to grow in places like Singapore, Hong Kong, Dubai, these more permissive financial hubs that are going to have more permissive regulatory frameworks, even though they have much smaller markets. My hope is, and the thing that we're working towards on behalf of the DeFi community in Washington, from many trips there myself and with our team, is that the decentralized finance community is regulated more permissively, kind of like the internet in its early days was regulated very permissively, which had a very big benefit for the US economy, right? Because the internet wasn't something that was difficult to build things inside of, which is why Silicon Valley and the first internet companies were so successful in the US, because the government didn't stop them from getting built in those in the Valley and in the US in the US kind of system, and US internet, which essentially has become the global internet. The US internet has expanded to do that. So regulators face a difficult thing where they have a financial system, but they have this dynamic of wanting the internet to be within their world, within their country. And so they have to walk a pretty fine line where they don't make it so permissive that there's real market risk or consumer risk, which I also understand is a serious consideration. But they cannot make it so onerous for decentralized finance to operate in the US or in relation to digital assets that everyone chooses not to operate in the US, which is, by the way, up until the Trump administration, where all of decentralized finance was. It was operating in Hong Kong, Singapore, Dubai, places like that, which is not what the US and not what Europe wants. Europe has a bit more progress on this with MICA, but still there really needs to be more clarity, but not in the onerous way. I think that would be the type of mistake similar to regulating the internet in the 90s because of pornography or the ability to send emails about illegal things. So it has to be very measured for that reason. And just to be clear, decentralized finance, I think, will grow to become a very large portion of the global financial system, at least 20, 30%, maybe more. So this is not something that you can make a mistake as a regulator and still experience economic success in your economy.
Now, you're talking there about the global financial system. Let's look at capital markets. How do you see this acceleration of digital assets impacting capital markets?
I actually see a huge amount of efficiency getting generated, and I see the markets fundamentally working better, both for institutional participants, for the mid-tier, family office, hedge fund class, and for the retail community through providers of their financial products, which are mainly applications, web applications, mobile application providers. And the reason for that is that the current financial system is very disconnected. There's lots of siloed data in different institutions. There's lots of siloed markets in different geographies that can't interoperate across geographic lines. There's lots of siloing of capital. And there are huge costs to generate new issuances, new financial products, new exposure to risk or risk management approaches. Mm-hmm. This has definitely benefited the largest incumbents, which is why there's so much consolidation, because it's so difficult to do some of this stuff, and because there are some economies of scale. I think what's going to happen now is we're all going to experience greater deglobalization in other parts of the economy, like global trade, manufacturing, certain levels of IP ownership and others. But I think we will actually experience extremely rapid interconnectivity and globalization in the digital asset part of the capital markets. And globalization, which means basically the connection of different global markets to the benefit of the market participants, is an extremely powerful force. I mean, it's the force that has created, the lives we all lead today, with all the goods that we consume and all the travel we benefit from, and every other thing we really have is, I think, at least 30% related to globalization. So I think people will realize that the digital asset format is very superior. I think they'll start doing more issuances in that format. I think markets work better in that format. And importantly, I think that format is inherently globalized. It's inherently prone to global liquidity, global connectivity with less friction, less cost, less complexity. And you really can't compete with global liquidity. Like your market's local liquidity, even in the US, is a lot, and it's enough to be successful. But still, everybody who does an issuance, everybody who does anything in the capital markets, they fundamentally want access to the world's liquidity. And the digital asset systems and format and way of doing things is what will come to give them access to that global liquidity, much, much more than the traditional financial system. When that happens, it will be one of these things where everyone says, oh, well, it was obvious. That's when they will say it was obvious, when the global liquidity is available to you much, much more and much easier through digital assets than traditional assets.
I'm going to stop you there, Sergey. I'm just going to ask you, perhaps, as we come to a close, we're talking there about access. In a few words, what do you think are going to be the biggest enablers towards this acceleration of adoption to digital assets?
It's kind of a biased and self-serving answer, but I think because I see how many systems need to work with each other, I think connectivity is actually the critical thing that needs to happen now. I think you've had enough chains get generated. So there's enough chains out there, different chain technologies, thousands of different chains, private chains, public chains. You also have existing systems, existing data systems, existing accounting systems, existing fund administration systems. Those systems cannot be removed, actually, for legal and regulatory reasons, because in many cases, whether it's about control location or whether it's about regulatory requirements for how valuations are done or accounting is done or any number of other requirements, you can't get rid of those systems. So you have to make all the chains compatible with each other. You have to connect them so that that stablecoin purchasing power and liquidity can flow across those chains. You have to connect the data systems into the chains so that there's market data, reference data, corporate actions data, all the data that's necessary to operate these tokenized equities, commodities, and funds. And you also need to connect all of the existing systems, the accounting systems, the fund administration systems, the private key management, secure systems of the banks and the asset managers and all the market participants. And the friction of that connectivity and the cost of joining a network or joining a system is really the limiting factor that we are now focused on removing. So that's really what Chainlink does. It's kind of in the name Chainlink. The point is to link all the things related to chains such that the cost of transacting and the cost of entering the system of transaction, the digital assets system of transaction, is low. So I think there'll be more chains. I think there'll be more digital assets siloed across these chains. I think there'll be a continual need for existing systems, existing accounting standards, existing fund administration processes, and existing servers and existing backends to all interoperate with all these chains. And the lowering of the cost of doing that, the lowering of the cost of implementing that, the lowering of the transaction cost related to all of that interoperability, connectivity, transactional kind of workflow and steps is I think the limiting factor that we want to eliminate. That's a key factor. There's also a key factor of privacy. So institutions require privacy, and the most successful blockchain systems have provided privacy to institutions in some form. All of those forms of privacy have been very limited and have not met the full requirements of the institutions, and actually often eliminated other benefits and other capabilities that they wanted because the privacy made it impossible to have both. And so we're also introducing something called confidential compute that will allow the processing of all these institutional transaction details, synchronization with existing systems, but in a private way that can then be proven back to chains in a way that the chain, the regulator, the counterparty, the issuer, everyone can rely on those guarantees.
And I'm listening to you now, Sergey, and I'm just hearing you talk about the chains and the privacy. And there is so much going on when we even spoke earlier about how digital assets was the talk of Sibos almost. So 2026 is certainly going to be a year to watch. And I just want to say thank you so much for your input. It'll be interesting to talk a little bit further down the line in 2026 to see where we are. But thank you for joining us.
My pleasure. Thank you for having me.
Thank you.